Hello, my name is Dan Eisenhower with Compss Rose Investments, and today I'd like to talk to you about creative financing of real estate purchases for investors. Why invest in real estate? First of all, you get passive income. You're not trading your time for money. You can become extraordinarily well paid for putting in a small amount of time. You're protected from inflation both on the market value of the property and on rents. As inflation goes up, the market value of the property and rents also increase. The value of real estate is slow to fluctuate, as opposed to stock market, which can go up and down 10-15% in any given day. You retain control over what you're going to invest in. You decide what you're going to invest in and what the terms of investment are going to be. Real estate is an imperfect market, because you can buy for less than market value in some circumstances. In 2011, Jim Flaherty, the Minister of Finance for Canada, changed the rules for buying real estate, and that particularly affected investors. Prior to 2011, we could get up to 90, maybe even 95% loan-to-value ratio financing. We could get 40-year amortization of our loans, and there were a wide variety of approvals that were available to us. Beginning in 2011, these options became more limited. We could now only get 80% loan to value with a 25-year amortization, and the borrower must qualify for a 5-year term interest rate. Well, that's what the government says, but that isn't necessarily so. Flaherty's rules only apply to CMHC guaranteed loans, and other insurers such as Genworth and lenders not insuring with HMSC are not obligated to follow those rules. And the marketplace is ripe for creative financing deals. You don't have to own real estate to get wealthy from it. Here are some examples. Down payment provided, and I've got an example of that later in this presentation. Sweat equity, buying a fixer-upper, fixing it up and increasing the value. Changing the use of a property, such as buying a warehouse and converting it to residential condominium. Renting to own is an acquisition strategy. A mortgage guarantee. This would be where a purchaser does not have the credit rating to borrow the money, so they go to a guarantor. The guarantor will get a percentage of the income from the property but put no money up. Assigning or selling the contract to a property. Vendor-provided financing is always a great way to buy with little money down. Another way for increased equity is to change gross leases to net leases in older commercial buildings. Here are some examples of projects that Compss Rose or associates have done. In this case, foreclosure had started on this 4-unit building in Edmonton, and the purchaser assumed a 40-year mortgage at very preferential rates. They paid $60,000 more or less to bring the mortgage current and to do necessary repairs within the building. The purchaser paid about 10% of the market value for the property and got cash flow of about $1,000 per month. So in this case, the purchaser won because they bought a $600,000 property with 10% down. The lender got a more reliable investor, and the seller had the foreclosure taken off his record. Here's a vendor take-back in Surrey, where the owner couldn't sell at market value, so the established purchase price was $200,000, which was a little above market value. The seller provided a $190,000 mortgage at 4% over 40 years. The purchaser and investor had a $200 per month shortfall, but they were prepared to carry that. With appreciation both in rents and the market value of the property, plus principal paydown over 10 years, they had approximately a 14% annual rate of return. 22 townhomes in Richmond. This is one of my favorite stories. The contractor was in financial difficulty. We found an investor who rented all with an option to buy. No option fee was paid by the investor, and the rent paid to the contractor was enough to carry the contractor's out-of-pocket costs, mortgage, insurance, taxes, etc. The final purchase price was based on the outstanding balance of the mortgage at closing. So the investor did a rent-to-own on all the units, straight rental and some to reduce the outgoing cash flow. They collected option fees from all the tenant buyers, collected rent-to-own rents, which is about 25% above market, and sold at market value at the time of the sale to the tenant buyers. The investor's return on investment was close to infinite because of the low cash in the deal, and the investor made $1 million plus profit on this deal. Here's what they paid going out. They paid rent to the developer while the units were vacant. They collected option fees, but the option fees paid for the outgoing rent within a very short period of time. No option fees were paid to the developer. And the final purchase price was the outstanding balance in the mortgage plus a fixed amount. The purchase price declined over time. Here's an example of down payment provided. In this case, the market value of the house was $320,000. The purchase price to the investor was $235,000, which he paid cash. And that investment was held for about 2 weeks when we sold it to a tenant buyer. The tenant buyer qualified for a $256,000 mortgage, and the investor was returned $31,000, which included a $10,000 deposit from the tenant buyer. The tenant buyer and the investor then did a joint venture, sharing each 50% in depreciation and principal reduction in the mortgage over a 5-year period. The investor's cash outlay was the original purchase price for cash for approximately 2 weeks, plus legal costs and deed transfer tax. As mentioned earlier, all the cash was returned when sold to the tenant buyer 2 weeks later. A rent-to-own deal in Surrey. This was done for a tenant buyer. So the property was purchased for $350,000. The investor put in $79,250 from their RRSP. The monthly rent was $22.75, and the monthly cash flow to the investor was $740. Sale price in 3 years at 2% appreciation per year would be $371,000, and the investor's annual ROI was well over what was attainable through GICs. An interesting vendor takeback on 4 units. The purchase price was $550,000. The vendor carried 115% of the purchase price for 10 years at 0% interest. $30,000 was paid on closing, and the monthly payment, principal only, was $1,800. Cash flow to the investor was $1,200 per month, and the investor will refinance in 10 years to pay out the vendor. The investor would have their original investment repaid within about 25 months at the $1,200 per month cash flow. So who'd sell at these steep discounts that we're talking about here? Divorcing couples sometimes can't settle their arguments, their differences. Transferees who are in a rush to sell. Somebody going on a federal vacation or to jail. Foreclosures, job loss, health issues. These are all folks who need help and are often willing to accept reduction in prices to get their properties sold immediately. Revenue Canada, or Canadian Revenue Agency, allows registered accounts such as RESPs, RRSPs, LIFAs or LIFAs, registered disability savings plans to invest in Canadian real estate through mortgages on Canadian real property. There are 2 types of RRSPs. First one is a non-arm's length, which includes yourself, your children, including adopted children, spouse, parents, and any company in which you own controlling interest. An arm's length includes friends, uncles, aunts, cousins, strangers, and any company in which you do not own a controlling interest. The rules for each of these are different. Here's the process. The RRSP owner finds a property that he or she would like to invest in. The RRSP owner and the borrower agree to the terms of the mortgage, and then the RRSP owner selects a trustee to manage the account. All three parties sign the various legal documents that are required under this agreement. Payments are made as agreed by the borrower to the trustee, generally through EFTs or pre-authorized payments. The trustee reports to the RRSP owner, both online and on paper. With arm's length mortgages, there are no major requirements for qualifying or loan-to-value ratios. But with non-arm's length, there are qualifying requirements very similar to conventional lenders and loans, and I won't go into those right here now. The benefits of RRSP mortgages: that the RRSP owner controls the investment. It's simplified tax planning. There's a predetermined exit strategy. Real property secures the investment, and it's a consistent high rate of return. No time or expertise is required to manage the investment. If you'd like more information, you can contact us at info@nomoneydownhomescanada.com or phone us at 1-888-982-9151. Thanks for watching.